Okay, yes, I'll begin now. Hello, welcome. Thanks for joining us. Today we have Fred Fuld as our guest of honor. Fred was a former executive in the financial services industry who started out working as a stockbroker, and later as a market maker on the options floor of the Pacific Stock Exchange. He then became vice president of a San Francisco-based investment management firm, and he also worked as an adjunct professor for a College of Business at California State University. He is the publisher of WallStreetNewsNetwork.com and has written numerous articles for various publications, including Friends of Financial History magazine and the Bond and Shares Society Journal. Television appearances include CNBC, Fox Business News, and Globo TV. He also has given speeches at the Museum of American Finance in New York City, the Money Show in the San Francisco and Las Vegas, California State University, East Bay, and numerous other venues. He is the author of the books Investment Trivia, Stock Market Trivia, and Real Estate Trivia. So without further ado, we have Fred Fuld.
Thank you. Well, thank you for inviting me. And what I'm going to talk to you today about is, well, first of all, what stocks are, and a little bit about the terminology and what makes a stock go up, that type of thing. And I know we're going to have questions at the end, so feel free to ask any questions that you like. If there's any glaring thing that you're not sure about, I'd be glad to answer those questions as I go through. All right, so first of all, and I know that some of you have very little or no experience at all with investing or the stock market. Some of you have probably already invested, so I'm going to try to appeal to everybody if I can. Now, there are certain areas of the presentation where it's not really that important, and I'm just going to kind of gloss through those areas. And but if you do have questions about them, let me know. They usually aren't that important, and I want to concentrate on the areas that are important. So the first thing is, what is a stock? And a stock is basically a share of ownership in a corporation, and a corporation is a legal entity. They're allowed to issue shares, and once those shares are issued, the individuals that own those shares have certain rights, and the corporation itself also has rights very similar to what people have. For example, they can actually have bank accounts and own other stocks. They can own buildings. They can enter into contracts, that type of thing. Now, I want to give you an example about how shares work and the difference between authorized, issued, and float, which I'll explain in just a second. Let's say there's a company that has 1 million shares, and it's started by two people that started their own startup, and they issued 100,000 shares to own, but they have still have 800,000 shares that they haven't issued. If eventually that stock goes public, what they can do is they can issue those 800,000 shares when they sell those shares to the public. And at that time, the difference between, or the amount of shares that are held by the public are referred to as the float. And so those are the shares that the public actively trade. It's not the shares that are owned by the founders of the company. Now, if those founders eventually sell off those shares, those would be added to the float. And you may wonder, well, why is that important? Why should I care about the float? Well, the lower the float or the smaller the float, the more volatility and more fluctuation in the stock. In other words, if those same founders own 900,000 shares and there are only 100,000 shares in the publicly traded float, you can see that there would be so many fewer shares trading that those shares could bounce all over the place, and there wouldn't be that many owners involved in the actual trading of those shares. So that's just something to keep in mind. Now, one thing I want to mention, back in the old days, they used to issue paper shares of stock, and this is an example of Enron, which was a famous bankruptcy, also a famous swindle and scandal And today, it's almost impossible to get a paper share issued. As a matter of fact, most companies, or many companies these days, such as Twitter and Facebook, don't even issue paper shares anymore. And the companies that do issue paper shares, it's impossible to even get them issued through your broker if you buy stock in the company. So today, everything's electronic. Okay, so I want to talk a little bit about investment terminology. And this may look like a big bunch of words that I'm throwing at you, but I'll go through them as simply as I can, and they should be pretty informative. And I'm not going to go into a lot of detail about a lot of them, except for two of the items, which I'll talk about in just a second. Okay, so first of all is IPO. That stands for initial public offering, and that means that a corporation is going public. They're selling shares to the public and allow the public to trade in those shares. So a lot of companies have gone public recently, but over the years, a lot of investors wanted to get in on those public offerings because a lot of times those shares would shoot straight up after you bought those shares. It hasn't happened that much lately, but that is something that does happen. Okay, so the next one on the list is points. Now, if I say my Apple stock is up 3 points today, that means it's up $3 per share today. So those two terms are used interchangeably. Now, when you're talking about stock indexes, like the Dow Jones Industrial Average, and you say, well, the Dow is up 50 points today, it's kind of like dollars, but which I'll get into later, but it's referred to as points. So I just want to point that out to you in case you hear somebody say, hey, I made 5 points on this stock today. That means $5 per share. Okay, the next two items, bid and asked, and I'm going to cover those on the next slide in more detail. Basically, the bid price is the highest price that somebody is bidding or willing to pay for a stock. And it's what you, if you own the stock, can sell the stock at if you want to sell it right away. The asked price is the lowest price that somebody is willing to sell their shares at, and it's the price that you would have to pay if you wanted to buy it right away. If that sounds convoluted, don't worry, because I'm going to clear it up in the next slide. But okay, then the next two terms, aftermarket and pre-market. Now the stock market where you are, it opens you're 2 hours later, so that opens at 8:30 in the morning and it closes at 3 o'clock in the afternoon. However, you can still often do transactions in what's called the pre-market, which would be before 8:30 a.m. or after 3 o'clock in the afternoon. So that's what that means if you hear anything about pre-market trading or aftermarket trading. Okay, limit order. Now, limit order refers to an order that you want to place, that you want to pay just a particular price for a stock. For example, if a stock is trading for $26 a share, but you don't want to pay any more than $25 a share, you can place that order and say, okay, I want to buy 100 shares at $25 and not a penny more. That's called a limit order. If a stock is trading at $26 and you just want to buy it, you just want to get it, you don't want to wait because you think it's going to start moving up right away, you can place what's called a market order. And that means you would get whatever the going asking price is for that particular stock. And in that example, you probably get around $26 a share. Okay, next two items, bear and bull. Now a bear is somebody who thinks the market is going to drop, and a bull is someone who thinks the stock market is going to go up. A bear market is a falling market, a bull market is a rising market. And if you have trouble remembering the difference between the two, just remember a bear knocks you down on the ground, so think of a falling stock market, and a bull knocks you up in the air, so think of a rising stock market. Okay, over to the right is options. Now I could give a whole hour on options, and I'm not going to because it can get fairly complicated, but I just want you to understand really basically what they are. a call option is the right to buy a stock at a particular price within a certain period of time. Usually they're issued in 3-month increments. And a put option is the right to sell a stock at a particular price within a certain amount of time. And I could go into a lot of detail about those, but I don't want to. But just so that you're aware, you can lose everything in that 3-month time period, or you can double or triple or quadruple your money while the stock may only go up, $5 or $6 a share. You could make $300 or $400 or $500, 3 or 4 or 500% on options. Okay, next we get to penny stocks. Now the SEC, which is the Securities and Exchange Commission, that's the governmental organization that oversees investing, refers to penny stocks as any stock that trades for less than $5 a share. However, most traders and investors really consider stocks that trade for less than $1 a share as a penny stock. In other words, 99 cents down to a penny. And actually, there are even some stocks that trade for less than a penny, if you can believe it, like 1/10 of a cent, 1/2 a cent, that kind of thing. Okay, ETFs. ETFs are exchange traded funds. And what those are, they are, I don't know if all of you are familiar with mutual funds. Mutual funds are companies that invest in a bunch of different stocks. So it gives you a lot of diversification, but they only trade once a day after the close of the market, and their price is based on whatever it is at the end of the day. ETFs are basically the same thing. They're companies that own a whole bunch of different stocks, but they trade all day long just like a regular stock while the stock market is open. And there are a lot of ETFs that invest in various types of industries and so forth. Okay, the next term is market cap. Now, market cap is basically, in real simple way to put it, is the price per share times the total number of issued shares. So for example, if there are 1 million shares that have been issued and the stock trades for $20 a share, the market cap is $20 million. Now, the reason why this is important to know is that the lower the market cap, the more speculative the stock is. There are certain stocks now that actually have market caps of over $1 trillion, like Apple and Amazon. Many of the large corporations trade at market caps in the billions. But once you get into the millions, they're fairly small. They're considered very small companies, 10 million, 15 million, 20 million, even 50 million, 100 million. Those are considered very small stocks and, of course, very speculative. Okay, the next item on the list is stock splits. Okay, we've had 2 stock splits recently from major companies. One was Apple and the other one was Tesla. And the reason why companies split their stocks is they want to make what's called a round lot. It's 100 shares accessible to more investors. And so they end up splitting their stocks. Now what that means is, I'll use a 2-for-1 stock split as a real simple example. If we have 1 million shares, total shares issued, and the stock trades for $20 per share, and it splits 2-for-1, that means they've doubled the number of shares from 1 million to 2 million, yet the stock price immediately will drop to $10 a share. So if you had 100 shares and it's trading at $20, you'd end up with 200 shares, but it would be trading at $10, assuming everything else remains equal, assuming no fluctuation in the price of the stock. So there really isn't much advantage to an investor other than the fact that if you want to own 100 shares, you're more capable of doing so because the stock is trading at a lower price. And I think the 2 companies that I just mentioned, one had a 4-for-1 split and the other had a 5-for-1 split because they were trading at such high prices. Okay, next item on the list is a secondary offering. Basically what that is after a stock goes public, maybe it needs to raise more money a year or two later. And what they can do is sell additional authorized shares of that they have available to the public in order to bring more money in. And so in my example of the million share company, let's say that the two founders own 200,000 shares and the company in their IPO sold 300,000 shares. Well, maybe they can have a secondary offering of, say, 100,000 shares because they still have 500,000 authorized that they still haven't used yet. Okay, the next item on the list is SPACs, which stands for Special Purpose Acquisition Companies. Now, these are companies that are also called blank check companies. And what that means is when they went public with their IPO, they stated in their prospectus, and the prospectus is what's issued to new investors, that they have no business at all and they're going to try to find a company to merge with in order to be an ongoing company. So it basically says, we don't own anything, we're just going to raise money, we hope to find a nice company to buy. And it sounds kind of strange that companies would do that, and they're normally issued for around $10 a share. But there have been a couple of successful ones recently. For example, I don't know if any of you have heard of Virgin Galactic. It's the company that's going to authorize or have space travel for the public. And then another one was DraftKings. It's the online gambling company. They both went public through these special purpose acquisition companies. And what they did was the people that managed the SPACs found these companies, these private companies that wanted to go public, and they did a merger. So now the public can own shares in these companies. Okay, the last item on the list is short selling. And short selling is making money from a stock that drops in price. And I'm going to try to explain it real simply. And just keep in mind this all happens electronically. But let's say you think a stock is selling for $25 and you think it's going to drop to $20. What you can do is sell the stock short. And what technically happens is you borrow the shares, you sell them immediately, say at $25. You hope that they drop to say $20. And let's say that does happen. Then you buy those shares back, and then you have to return those shares that you've borrowed. The difference between the $25 and the $20 is your profit. Now, one thing to keep in mind with short selling is your upside, the amount of money you can make is limited. In other words, the stock can only drop down to 1 cent a share, but the amount you can lose is unlimited. I mean, the stock could theoretically jump to $50 a share or $75 a share or $100 a share. Now that doesn't happen very often, but I've actually seen a stock once that it was trading for around $7 a share, and some people had shorted the stock, and the next day it opened up at $14 a share, then jumped to 17, then jumped to 21, and the investors or the traders had to scramble in order to cover their positions. And of course, the difference between what you sold it at and what you buy it would be your loss if the stock went against you. So that's short selling. Okay, now what I want to do is I want to explain what makes a stock go up and what technically makes a stock go up. Even there are a lot of things that can affect stock prices, like news items and fear of missing out and all that kind of thing. But I want to actually kind of explain to you how the bid price and ask price works so that you understand, okay, what's happening when I place a trade. So let's take an example. We'll just say the stock is XYZ. Somebody is willing to buy, and they've placed an order to buy a stock at $20.10. Let's say that somebody that owns the shares is willing to sell their shares for $20.20, and they own 100 shares. Okay, so now you want to buy that stock. Now what you could do if you want to place a limit order is you could say, okay, well, I'm going to place a limit between $20.10 and $20.20 and place it at $20.15 a share and hope that you get it. But then you may say, gee, I just read the news on this stock. I just want to buy it. Okay, so you go ahead and before you buy it, I want to explain the only other person or the next person in line that wants to sell has some for sale at $20.25. The next person after that has some for sale at $20.30. And after that, $20.50. Okay, so let's say you go ahead and you buy those shares. You want to place what's called a market order, which means I want to place it whatever the going market is. So you end up buying your shares at $20.20. Okay, somebody else comes along, they saw the same news. Okay, I want to place a market order also. So they have to pay now because this person has sold their shares at $100 a share. The next person has to pay $20.25. And they pay $20.25 and they bought their 100 shares. Now the next person after that, they have to pay $20.30. And the next person after that pays $20.50. So you can see how the price goes up based on people that want to buy the stock at the market. I mean, the old saying was more buyers than sellers cause the price to go up. That's only half right. It's more buyers at the market that cause stock prices to go up. Now, and one other thing to keep in mind is that the last trade price that you see may not be the price that you can get. Like the person that wants to buy it right after this $20.30 trade, they would have to pay $20.50, even though the last price shows $20.30. Okay. All right. Now this, I don't want to spend any time at all on stock indexes. Basically, the three main ones are the Dow Jones Industrial Average, which tracks 30 stocks. S&P 500 tracks 500. The NASDAQ tracks over 2,500 stocks. And one thing to keep in mind is it's kind of weighted towards technology stocks because most of the tech stocks got listed on the NASDAQ as opposed to the New York Stock Exchange. And I really haven't talked about stock exchange much, but the two biggest are the New York Stock Exchange and NASDAQ. Okay, types of investing. Now, there's day trading, and what that means is you're basically buying a stock and then hoping to sell it the same day, or if you're short selling, hoping to close out your position the same day. There are a few day traders that hold overnight, and what holding overnight means is you basically don't sell your stock before the market closes. You wait until the next day, hoping it'll go back up. But most day traders will try to close out the end of the day with what's called a flat position, which means they don't have any positions at all, so they don't have to worry about some strange news item causing their stocks to drop. Now, a swing trader is somebody that basically trades stocks, but holds their stocks for a longer term, like from 2 days, and it could be up to 3 months. Maybe they see that the earnings are coming out for the company in a month from now, and they see that the stock is way down today, but they think the stock's going to come out with great earnings, so they might buy it now and hope that in a month or so they can sell at a profit. And then investing is basically investing for the long term, and that could be years. And the only reason why you would sell would be if there's some major problem with the company or the stock. Okay. All right. Opening an investment account. Now, all trading now is done online, whether you do it on your laptop or your phone. And the first two companies that I list here, Robinhood and Webull, they specialize in having an app-based trading platform on your phone. All the others have apps for the phone also, but it's the first two that kind of specialize in that. One thing that I haven't mentioned, which I think I'll mention now in case I don't mention it later, is how much money do you need to open an investment account? And the answer is for most of these, there is no minimum. You could open an account with $5 if you want. And I think for most of these on the list, you could theoretically, open your account, and actually you could open your account with $0. But to actually put money in, most of these will accept $5. Now I think Interactive Brokers requires 25,000 or some really high amount, but most of the other, at least the first 4 on the list that I'm aware of, they will take very small minimums. Now, how much should you have an account? I like to tell people that it's kind of a good idea to have around $500. You don't need $500. I mean, there are traders that work with $100, and they trade very low price stocks. But it's a good idea to start with $500 if you have that available. Now, if you're going to trade options, you're required to have at least $2,000, and some of the brokerage firms require $5,000. Another thing that I haven't mentioned is trading on margin, and that's where you actually borrow some money to put up to invest in a stock. Like say you wanted to buy $2,000 worth of a stock, you could put up $1,000, and then the brokerage firm puts up the other $1,000. That has to be done in what's called a margin account, and at least the first 3 require at least $2,000 to do that. I don't recommend any new investors do that, and even long-term investors, you're better off using options or something like that, because if you buy stocks on margin, you can actually lose more than the money you put into your account. So anyway, I can talk about that more later if you want. Okay, so that's basically it. Most of this can be done online, and in transferring the money to the brokerage firm can be done usually with what's called an ACH or ECH, which basically means a simple transfer from your bank account to the brokerage firm. I don't believe any of these allow you to put in money with a credit card. They may allow it with a debit card. Okay, analyzing stocks. Okay, first of all, there's the fundamental analysis. And fundamental means you looked at the various ratios, the various financials of the company. Have their earnings been growing? Have their revenues been growing? And in terms of the ratios, probably the 3 most common I've listed here: the price to earnings ratio, price to sales ratio, price to book ratio. And what that refers to is well, I'll take price to earnings ratio since that's the most common. If you have a $20 stock and the earnings per share is $1, then you divide that dollar into the 20, which gives you 20, and that's the PE ratio. If that stock, say, has earnings of $5 a share, which is really good for a $20 stock, you divide the 5 into 20, and that has a PE of 4. If the stock has a earnings per share of 50 cents, you divide the 50 cents into the price, the $20 price, and that works out to 2040, which is not very good. Now, a good price to earnings ratio is somewhere between 10 and 20. A good price sales to ratio, anything below 1 is excellent, but between 1 and 2 is average, above 2 is excellent, is bad. Anything high is bad. A price to book, what book value is if the company went out of business today or just stopped operating, sold off all their assets, distributed the amount of money to each shareholder based on the number of shares they have, that would give you the book value per share. So if you can buy a stock below book value, that's a pretty good price. And there are all kinds of other ratios. I don't want to go into detail on them. And one of the unusual things about fundamental analysis is lately a lot of the stocks that have been doing really well have had terrible ratios. For example, Peloton, the exercise company, they don't even have any earnings, so they don't even have a PE ratio. Zoom is another example. Their PE ratio is like 663. I mean, it's so high that if you look at it, you say, oh, this company should be worthless, but the stock keeps going up and up. Okay, so then there's technical analysis, and that's looking at charts, and that could be a whole other whole hour of topics, which I don't want to get into. Another way of analyzing stocks, and this is if you're investing for the long term, is buy stocks of the companies that you do business with that you like their service or you like their product. Like, are you on Facebook a lot and do you like Facebook? Then you might consider buying it. Same thing with Twitter. Do you order stuff on Amazon? Do you own electronics made by Apple? Do you have an iPhone? Do you like Apple? Things like that. If you're investing for the long term, you shouldn't even worry about the day-to-day or even the week-to-week or month-to-month fluctuations in the stocks. You should just buy it because you like the company and you think they will do well over the long term. By the way, that's how I invest for my long-term investments, just in case you're wondering. Okay, real briefly, I want to just tell you about dividends and yield. A lot of people buy stocks because they think the price of the stock will go up. But then a lot of investors will also buy stocks because some of them pay dividends. I think of the big companies, about half of them pay dividends. And what dividends are, they're the payout of a portion of the earnings to the shareholders. And if you want to know, what sort of a yield those dividends are based on the price of the stock, you basically take the annual dividend payment and divide it by the stock price, and that's what gives you the yield. Some stocks pay, 1%, some stocks pay 5%. A lot of investors that invest for the long term like to own the dividend stocks because basically it returns your capital over a period of time while you're waiting for the stock to go up. Second of all, you can reinvest those dividends. Third of all, there's usually less fluctuation on the dividend stocks as opposed to the growth stocks. And growth stocks, by that I mean stocks that do not pay out dividends, but just reinvest their earnings back into the company. Okay, so that's dividends. Okay, diversification. Now, if you're not trading and you're investing for the long term, and this looks like an overwhelming list, don't worry about it. I'm going to explain what it means in a second. You should invest in more than one sector. And by that, I've listed all the different sectors on that list. Everything from energy to financial to healthcare to real estate to technology to utility stocks. So all those are what are referred to as sectors. And think of those as like umbrellas for industries. There are a lot of industries within each sector. So I'll just take a real simple example like technology. You have the chip makers, you have the companies that make the PCs, you have companies that make apps, you have companies that make software for businesses. So all those different industries are within that sector. So if you ever hear the word sector, it's probably one of these on this list. And I kind of broke out what the difference is between consumer cyclical and consumer defensive, because a lot of people don't understand what the difference is, and sometimes I forget. But basically, consumer defensive means stocks that people always have to buy. They make products that people always have to buy or always will buy, like beverages and household products, everything from toilet paper to paper towels to cleaning supplies, that type of thing. The cyclical, which isn't necessarily cyclical in terms of when people use it, are things like restaurants, casinos, clothing, that type of thing. Okay, and then so we've got the sector, we've got the industries, and then if you have a big portfolio, you might want to have more than one stock in a particular industry. Okay, setting goals. Well, you can set your short-term goals if you're investing for, and this is something to keep in mind, which I'm going to cover real briefly on the next slide. If you need your money for a certain reason, like you want to buy a new car a year from now, you want to buy a house 5 years from now, you have to kind of keep that in mind. You don't want to invest in stocks that are too speculative, where the stocks may drop at the time you actually need the money. And then I want to just briefly tell you about something called dollar cost averaging. Now, what dollar cost averaging is, it's investing the same amount of money on a regular basis, usually every month, into an investment. And most of the brokerage firms will allow you to do this, where you can invest, you know, whether it's $10 a month or $100 a month or $500 a month, whatever. And then so even if the stock goes down, but eventually recovers during that period of time when the stock is dropped, because you're investing the same dollar amount, let's say it's $100 and it's a $20 stock, if it drops to $10, then you're buying 10 shares when it drops. And then as it recovers, you're back up to buying 5 shares, but you've made all that money during the time that it's dropped. If the stock continues to go up, then you'll still make money. So it's just something to keep in mind if you do want to set up a regular monthly investment. Okay, now we're getting close to the end. We get to some of the fun stuff. Latest trends in investing. Now, options have been around for many years, but a lot of new investors have kind of jumped on the options bandwagon, because you can make so much money so quickly and with such a limited amount of money that a lot of young traders have decided, you know, I want to start trading options, because your downside is limited and your upside is substantial. So options, as I said, could be a whole hour of I could talk about options. But if you have any questions about them at the end, feel free to ask. Now, the next thing on the list is something called slices. And I want to explain what that is. Slices, I don't know if you're aware, but Amazon stock sells for $3,500 a share. Suppose you only have $35, let's say, and you want to invest in Amazon. Well, how can you do that? Well, now several of the brokerage firms have come up with slices. And basically what that means is you're owning a slice of one share of stock. You're actually a part owner of that company, but you don't own a whole share. In my particular example, you would own 1/100th of a share. So it's kind of a nice feature if you do want to get in on some of the more expensive shares of stock. Okay, and then some of the unusual industries. There's been a lot of these unusual industries coming out recently, like I mentioned space travel earlier with Richard Branson's Virgin Galactic. Lithium stocks have become real popular recently because of the use of lithium in batteries for electric cars. And so there are lithium mining companies, lithium battery companies. The cannabis stocks were real popular a few years ago. Some of them went from just a few dollars a share to over $100 a share, and then they since crashed. The fake meat companies have also become real popular, like I think it's Beyond Meat is one of the popular ones. I think it sells for around $190 a share. There are drone stocks that have become popular. There's online gambling stocks. There's all kinds of other types of stocks of various industries that have since become popular. Okay, and then there's Bitcoin, which is a whole different area, and it's not really stock market related, but I just thought I'd mention that because some of you may already be aware of Bitcoin. Okay, risk, I don't want to spend hardly any time on risk, but just real briefly, market risk just means the risk that the stock you invest in may drop in price. Liquidity risk means the ability to get out of your stock at a reasonable price. Now, some of the penny stocks may have what's called a really wide spread, and the spread is the difference between the bid and the ask price. And suppose you own a stock that sells for it has a bid of 10 cents and an ask price of 20 cents, and you buy a bunch of shares in that stock. And then you realize, uh-oh, I need this money for something. I need to do a repair on my car. Well, the only price you can sell it at is a bid price of 10 cents, which means you've just lost 50% of your money. So that's what that refers to. Concentration risk means if you're a long-term investor and you put too much of your investment in one stock. Inflation risk just refers to if you leave all your money in the bank, it won't keep up with inflation, whereas the stock market has always outperformed inflation over long periods of time. And then horizon risk just refers to keep in mind what you want to use your money for down the road. Are you saving to buy a house? Are you saving for retirement? Whatever, that's your horizon risk. Okay, resources. I should tell you that the first one is mine. I never make any recommendations on my website. All I do is come up with a lot of these unusual industries, and I list things like Warren Buffett's latest stock picks, that type of thing. And then there's Yahoo Finance, which is one of the most popular financial websites on the internet. FinViz has something called a stock screener and a screener is something that allows you to search for a particular stock based on the requirements that you're looking for. And so, for example, and FinViz has the most comprehensive stock screener I've ever seen. The site has a lot of ads. You can pay for a premium service that doesn't have ads, but you can still get on for free. So on the screener, just as an example, suppose you want to look for all the stocks of companies that are based in India that have a PE ratio less than 20 and pay a dividend yield of greater than 5%. You could come up with something like that. You can put even more screens in. It's very comprehensive. And then Morningstar, it's very similar to Yahoo Finance. It's kind of a backup or in addition to Yahoo Finance if you want to check on a particular stock. Okay, and then I'm on the last screen now, which is book resources, because I get a lot of requests about, okay, what would you recommend? Now the top 3 are classic books. Some of them were written 5 years ago or 10 years ago or 15 years ago. The 4th one on the list is, I have not read it, but it's got a lot of good reviews. Broke Millennial Takes on Investing. The last one, of course, is my book. But these top 3 are really good books about investing and about the stock market and can give you a good overview. Okay, so it looks like we have about 15 minutes left. And does anyone have any questions?
Yeah, I kind of what I've been doing is I just kind of I sell puts on index funds, and then once they get assigned, I sell covered calls on them. I was just wondering what your thoughts are on that strategy.
Yeah, that's a great strategy. And some of the beginning investors may not understand what you're doing, but basically, when you sell a put on something, well, if you own the put, you have the right to put that stock to somebody. You have the right to sell that stock at a particular price. When you sell the put, somebody can put that stock to you. But if you sell the put and it expires worthless, then you basically collect the whole value of that put. And that same strategy can be used for stocks. And sometimes, I make this mistake. I'll think, oh, here's a great stock. I think it's going to start moving up. And instead of buying the stock, say at $25, I could have easily have sold a put on that stock for maybe $2 with a strike price of $3. And if the stock drops to $23, if the stock drops from $25 to $23, and the put would still expire worthless, So I would still make money. If the stock stays at $25 or goes up, I still make money. If it drops from 25 to $21, I break even. It would have to drop below 21 to start losing money. So in answer to your question, I think that's a great strategy. Any other
Thank you
questions?
for answering.
Yeah.
Hi, I was just wondering what you think would happen to the stock market during this election or because of the election?
It's a great question, and I don't know the answer. And I've actually read a lot and even talked to some some major portfolio managers about that. And I can tell you what they've told me. And one expert said, well, if President Trump wins, the stock market's going to drop because he has no more reason to keep the stock market propped up through the Federal Reserve Board, flooding the economy with money. And I don't want to get into a lot of detail about how the Federal Reserve works, but and then another investor said, or portfolio manager said, well, the stock market is going to go up if President Trump wins because he's going to keep corporate taxes low, and that's going to be positive for the corporations. Okay, and then another portfolio manager said, well, if former Vice President Biden wins, the stock market's going to crash because he wants to raise taxes on corporations. And then another expert said, well, if Biden wins, the stock market's going to go up because people are afraid now that taxes or corporations are going to go up, but he's not going to get it passed. And so the stock market's going to respond in a positive manner. So in other words, I've heard all aspects of what the results could be. And my personal thoughts are I have absolutely no idea. I can tell you that I've cut back a lot on my trading and have many fewer positions, and I just want to see what the market's going to do after the election. I just don't want to take a chance. With my longer term investments, I don't worry about it because I'm holding those for, the next 10, 15, 20 years. And but if the market does drop, I want to have, a bunch of cash available to jump in. I hope that answers your question.
Oh, it does. Yeah, thank you very much.
You're welcome.
I have two questions.
Uh-huh.
My first one is what are some stock industries that we should not get into right now?
Okay, that's a good question. I'm staying away from the petroleum industry. I think it's kind of a dying industry. More and more people are buying electric cars and hybrid cars, and the government, no matter who's in power, there's still going to be limitations on how much carbon emissions can take place. And so I hate to use the word dying industry, but I think it's an industry that's kind of in a downtrend. Let me go back to my list here. So that's one area that I would stay away from. And right off the top of my head, that's one industry. Some of the other areas I think are okay. Healthcare will always be a strong industry, but that also includes the biotech stocks, and you have to be really careful about biotech stocks if they don't make their third phase or their second phase on a cure for whatever they're trying to cure or treat. Those stocks can collapse. They can go from $10 to $2 overnight.
Great, thank you.
Uh-huh. Did you have another question?
I did. So I see a lot of stuff on the internet about like how the stock market isn't a good representation of, it doesn't accurately reflect the economy itself. You might have something in the back. So if it's not an accurate representation of the economy, then exactly what is it representing?
Okay, it's kind of a tough question, but in general, it's reflecting the future. In other words, it's not reflecting what's happening today, but it's reflecting what investors will think about what's happening maybe a year or two from now. So the reason why the market has been up, now this is just my opinion, the reason why the market has been up in spite of the fact that many businesses have gone out of businesses, especially these smaller businesses, and a lot of people are out of work, we're losing their jobs, that type of thing, because of the pandemic. It actually got reflected back in March when the pandemic really hit, and we did have a huge drop in the market. But then I think more investors thought, well, eventually we're going to get through it. Eventually we're going to have a vaccine. Eventually we might even have some way to treat the coronavirus better, or to even cure it. And so it's kind of a long answer to your question, but I think the market is reflecting the future, and it's just a matter of how far in the future is it predicting. That I don't know. Some investors think that it's predicting, a year from now. It could be 2 or 3 years from now.
Okay, thank you.
You're welcome. Any other questions?
Yeah, in the future, if I wanted to like get into maybe starting my own hedge fund or something like that, is there any advice you would give to someone?
Yeah. Well, first of all, you'd have to find the investors. And if you have investors, if you have people that are willing to put up the money, then that's the biggest hurdle, because you may think it's easy, and you may have some wealthy friends and wealthy relatives, but when it comes to actually asking them for money, that's a whole different ballgame. So that's the first step. The second step is dealing with the regulatory stuff. And I think if the hedge fund is under a certain amount, I haven't checked the laws on this for a couple of years, but I think if it's under $50 million, then you don't have to make any reports to the SEC or that type of thing. You have to get your legal structure set up. You have to determine how much you're going to take out of the hedge fund. In the past, it has been 2 and 20. What that means is that you get 2% of the, let's see, I believe it's 2% of the returns per year, no, of the portfolio amount per year, plus 20% of any gain. So it's a really, to the investor in that hedge fund, it's a pretty healthy amount. It's a large amount that you'd be taking from the investors, and that's kind of a stumbling point. So, I mean, if you cut back on that, it might be more appealing to them. There is a hedge, or at least I used to subscribe to a hedge fund newsletter. If you do some research online for hedge funds, you may find it, and I can try to look it up at some point. Another thing you might want to do is look for any hedge fund groups, see if there's any on LinkedIn, any hedge fund groups, and join those groups. And I think that would be the way to go. There's a lot of different pieces to it. There's a legal issue, there's a money raising issue, there's the regulatory issues, and so forth. The accounting issues, you want to make sure you have a good accounting firm, because you would probably need to have your annual reports audited and so forth. So does that kind of answer your question?
Yeah, that was very helpful. Thank you.
You're welcome. Any other questions? Is everybody an expert on the stock market now?
I have a question.
Yes.
So what do you think about the price of commodities, especially gold right now? Because a lot of people are saying it's going, it's going to go up more from now, even though it's an all-time highs. What do you think about that?
Yeah, I actually like gold. I think everybody should have some gold in their portfolio, their long-term portfolio, at least 5 or 10%. And because the economy has been so flooded with money, we're going to get inflation at some point, and generally under inflationary environments, gold and silver start to go up. Now the issue is when will that happen? And gold was a little bit higher earlier this year, and it's dropped off somewhat, and then started to recover. And I think if you invest small amounts into gold now, it's a good idea to do it. And there are several ways to invest in gold. Actually, I'm kind of glad you mentioned this, because first you can buy GLD, which is it's like a gold ETF, but all it invests in is gold bullion. So that's one way to invest in gold. Another way is to invest in the gold mining stocks. There are companies like Yamana Gold and other types of gold mining companies. Some of them are very speculative. Some do pay dividends. Another way of investing is gold in gold is to buy the gold coins that are issued by, some are issued by the US government, the 1 ounce gold coins. You're basically paying close to what the cost is per ounce. And there's also the Canadian maple leaves and a few other gold coins from issued by countries around the world. I also like silver. And the advantage of silver, silver is used in industry a lot more than gold. It's used in, I don't know if it's used in catalytic converters, but there's a lot of electronic applications for silver. So you have a double upside with silver over and above gold. You have the inflation hedge, plus you have the use of that metal in industry. And there are a lot of ways to invest in silver. There's SLV, which is the silver ETF. There are silver mining stocks. And then there's also you can buy the 1 ounce silver coins issued by the US government. You can also buy what's called junk silver. And those are any coins, and this is the way to do it if you have small amounts of money. You can buy dimes, quarters, and half dollars that were issued prior to 1964, because in those days, those coins were 90% silver. Now, these days, they're all made with, I believe it's copper and zinc. And so you can buy like a roll of dimes prior to 1964 or earlier, and it's basically a way of investing in silver. And years ago, silver went, I can't even remember how high it got up to around $50 an ounce, I think. Now I think it's in the low 20s. I haven't even checked it recently. But that's a good way of investing small if you want to invest small. If you want to do trading, you can do GLD or SLV, or you can just buy those ETFs or the mining stocks for the long term, or buy the actual metal itself for the long term also. Does that answer your question?
Yeah, thank you.
You're welcome. Any other questions?
I have a question. When a stock dips, do you have any tips on when the bottom, finding the bottom of it?
Yeah, and it gets into technical analysis. And what you might want to do is do a little research on stochastics. I think it's spelled STOCHA, ASTICS, and MACD, MACD, that stands for Moving Average Convergence and Divergence. And what I do is it's kind of a way of tracking, you know, when the selling pressure is heavy and when the selling pressure lightens up. And what I do is I use on, I have an account with, where is the account? Let's see, with TD Ameritrade, which has a platform called Thinkorswim. And so now I'm back to the beginning. Thinkorswim, which has a really good charting feature to it. And I've set my MACD and my stochastics, and it basically puts it at the bottom. When I see a dip at the bottom and then I see a crossover, then I decide that that's probably a time to buy. The other way you can do it is looking at moving averages and seeing if there's a crossover in moving averages. So without getting too technical, that's how I would do it.
Thank you.
Uh-huh.
Sorry, just to add on to that, were you talking about, you know, looking at the hour-minute chart or 30-minute chart, or which one is the most efficient they use for the MACD?
Oh, I do that on the 1 minute chart for my trading. And yeah, I look at it at a 1 minute by 1 minute time frame. Long term, I don't pay much attention, but if I do see a stock drop in price, I think, oh, I've waited to buy this stock, now I'll buy it. But when I do trading, I look at the 1 minute chart. Any other questions?
I have a question. I was wondering, do options have any effect on the prices of an underlying stock?
Very rarely. I did hear that one major company, I believe it was based in Japan, bought a huge number of call options on some of the tech stocks, which caused the price of the tech stocks to go up. But in general, the options do not affect the price of the stock. It's, you know, the other way around.
And what about the Greeks? Which ones are the most important, do you think?
Well, I look at the delta. The deltas primarily. Sometimes the theta decay. When I have set up in, you know, one of my accounts where I exclusively do options, I try to stay delta neutral.
Thank you.
And sorry, just one more question. I just wanted to hear your thoughts on, you know, the news, you know, the long-term and short-term spread between the bonds on that yield curve, how it's basically being manipulated now. So before it used to be a really good way to predict certain outcomes. And because of quantitative easing and all the new tools that the Fed is basically using, do you think it's going to be a new way the market's going to be behaving? And we're going to have to like basically throw some things out the window that we used to have based on the new world that we have?
Yes. The short answer to your question is yes. And I think we're in a whole new world, you know, both with the quantitative easing and just the flooding the market with money and the buying by the Federal Reserve Board of corporate bonds. And I'm glad you mentioned that, because I think, you know, interest rates were at almost zero interest rates now. And I think interest rates will start to go back up in the future. And if any of you have the ability to buy a house and you can get a good deal and lock in a 30-year mortgage, now is the time to do it, because we can't go much lower on these mortgages. I just saw something on an email today. It said 2.5% on a 30-year fixed mortgage. And it hasn't been that low for maybe forever, as far as I know. I'd have to look back and see, but I mean, many years. We're talking at least 40 or 50 years when mortgages have been this low. So rates will eventually have to go up. They may start to rise after the election, and of course, bonds will start to drop. Remember, if you have a bond that pays 5% and interest rates in general go up to 10%, well, no one's going to want to pay, say, $1,000 for a $1,000 bond. They may give you $500 for that bond because the going rate is 10%. So yeah, it's going to be a whole different atmosphere now with the long-term and short-term rates, and we're going to see much higher rates, both short and long-term, coming up. I would say definitely within the next 5 years, and probably a lot sooner.
Thank you.
Uh-huh. You're welcome. Any other questions?
Yeah, I have a question. So with regard to long-term investments in the energy sector, do you think that nuclear or renewable is a better choice right now?
I think renewable is a better choice. I think nuclear has a lot of challenges, with what happened with 3 Mile Island and what happened in Russia and Fukushima and so forth. I think there will be a lot of challenges to building any new nuclear power plants. And, even though many consider it a clean energy, many states don't want the spent rods, stored in their state anymore. I know Nevada's been the dumping ground in the past, and I don't think the politicians there like that very much. So I think the renewables are the better way to go when you compare the two.
So would you say that you're skeptical about the future of thorium energy?
I'm not, I don't know that much about it. I think if we had fusion energy, if fusion energy really took off, then that would really solve a lot of problems. I mean, it's probably solve every energy problem. But fission I don't think is going to be the way to go. But fusion, fusion I think would be the way to go.
Okay, thank you.
You're welcome.
Sorry, I just have one more question.
Okay.
Since you were talking about real estate and the low interest rates, do you also kind of see this trend of, because they're so low, everybody wants to lock in these low interest rates for mortgages, and things do not seem to get better? Do you think it could kind of follow this trend of, like back in 2008 with the subprime mortgage rates, where you have a lot of people taking out all these payments that they, wouldn't be able to hold up, and that would kind of basically make it hard for all these big banks to, accommodate for all these failing mortgage rates?
Yeah, I don't think we're going to have the same thing that happened back in 2008, because back then they had what were called stated income loans. And I remember those days and I couldn't believe it. It was basically, it's hard to even describe. I mean, when you fill out the form, the loan broker would say, okay, and this could be like a self-employed person who makes maybe, $30,000 a year. They'd say, okay, you need to have $250,000 to qualify for this loan. So we're going to put $250,000 as your income because I'm sure you'll make that in the future. And they would put that on there. And that would be semi-legal back in those days. And it was just ridiculous. I mean, they were giving loans to people that, you know, obviously could never afford those loans, and it caused a huge bubble in the real estate market. And I remember I was writing in San Francisco, we have what's called the BART train. It's the Bay Area Rapid Transit. And I remember I was riding on the train back then, and I heard two mortgage brokers talking, and one of them said, you know what, I've run out of people to refinance with. I'm going to start offering loans to homeless people. And he was semi-serious because I remember getting calls, phone calls all the time, getting mailers all the time saying, we can refinance your house, pull money out of your house. And it just caused this huge bubble because people were buying houses and then flipping the houses. They would buy a house for say $200,000 and then sell it for $250,000 a month later because they were able to get this loan that they couldn't even qualify for to begin with, but they were able to do it. And there was you know, I knew there was going to be a day of reckoning, and of course that was the beginning of the big collapse. And because these mortgages were packaged up and they were sold to the major brokerage firms, and who resold them to investors, and it was just turned into a big mess. Does that answer your question?
Yes, thank you. It's kind of, yeah, not to be cynical about that. Yes, thank you.
Yeah, and these days we don't have that kind of atmosphere where anybody can just qualify for a loan. As a matter of fact, I just did a refinance a few months ago. It actually 6 months ago, and it took 4 months, and they did all kinds of, I mean, I could easily qualify, but they did all kinds of background checks. They had to check on my stock portfolio 2 different times, once at the beginning and once just before escrow close, and asking for all kinds of information about the most obscure types of things you could possibly think of. So I think the banks are more cautious now. So, I mean, we have had a kind of a rise in the market, but we're actually starting to see a drop in Silicon Valley and San Francisco, surprisingly, which was one of the fastest growing areas in the country. So if you can find any bargains in real estate, I think that's kind of a good way to go.
Yeah, the only reason I kind of go for that is because I work as a teller in a bank, and I see a lot of fraud and a lot of people basically going through SBA administration, and it's so easy to get a loan. They can get up to $60,000 in loan. They have a super low interest rate, and it's basically fraud. Basically, a lot of these people commit without, they don't even have a business.
Yeah,
and it's kind of like an ongoing thing.
Yeah, I just saw an article today about hundreds of Wells Fargo Bank workers, their employees actually got some of these loans, even though they were working for the bank, and most of them didn't even have side businesses or something. I didn't read the whole article. I just kind of skimmed the first couple of paragraphs, but yeah. So that's kind of a different thing from investing in real estate, although you never know, maybe some of these scammers will buy some real estate.
Yes, thank you.
You're welcome. Any other questions? No other questions? Everybody's comfortable now with investing in the stock market. No other questions? Okay, well, thank you for having me on. I hope you all learned some new things. Maybe some of you learned a lot of new things. And maybe if I check back with you a year from now, you'll all have doubled your money in the stock market.
Thank you so much. We appreciate it. I just have a few announcements for everybody. I'm going to start sharing my. Oh, could you, Fred, could you stop sharing your screen?
Yes, let me go to stop share. Okay.
Thank you. I don't know if everyone can see that.
Yeah, we can see it.
Cool. Okay, so just a few announcements, everybody. We ask you to pay for a membership. It's $10 for the semester and $15 for the whole year if you pay by October 29. This allows us to, throw these type of events for you. And we did reduce our cost since it's online. We didn't want to charge you as much as we usually do, so it's this price now. And you can pay us through Venmo with this link thing. I'll leave it up for a second. And then a reminder that we have our Professionals in Economics event in 2 weeks on October 29th. I'm going to change the screen now. Okay. So it's going to be a really good event to network and get to meet, people who work in economic related careers. And so if you would like to register for it, could some officers, could you put it in the chat how to do it? It's through Cougar Pathways. Someone will put it in the chat, hopefully. And finally, in order to prepare for that, we do have another event before that next week, a resume workshop at 6 p.m. On October 22nd, where you can learn more about how to properly draft your resume and make it nice and neat for the event a week after that. And as always, you can follow us on our social media to get updates about all of this. So yeah, thank you for joining us, and thank you, Fred, once again for the very informative